right, thanks so much for joining us here at Investing City. We're going to be going through with my fiance some questions that she had and her friends had, beginner investors who just want to know more about the stock market and investing in general. So tune in and I'm sure you'll learn a lot.
What's your take on options trading as opposed to buying whole shares?
Yeah, so options trading is a bit of advanced sort of investing technique. An option is a derivative of a stock. So let me just break down what that means. Basically, if you own a stock, you can sell or buy an option on that. And there's two types of options. There's call options and put options. A call option is if you think the stock is going up, and a put option is if you think a stock is going down. So let's say a stock is trading at $100 per share. You can buy a call option, and there's something called, I could go into the details, but basically you can leverage your return. So let's say you buy a call option at $110, so that's above $100, and the stock in a year goes all the way to $120. So what a call option does is you have the option to buy that stock at $110, even though it's at $120. So you purchase the option to buy a stock at some point in the future. And so what would happen is if it's above 110, you can immediately buy it at 110 and sell it at 120. And so basically, if the price of the option is less than $10, then you make money. Because, right, if you make $10, 120 minus 110, you shouldn't have paid more than $10 or else that takes all your profit away. So it's basically a way to ensure that you can buy a stock at a particular price. And there's all sorts of reasons why you would want to do that, but I'd say it's pretty advanced, and there's a study done that a huge percentage of all options expire worthless. So if you bought it that $110 option and the stock at the end of the time period was below 110, that means you purchased something and it's not worth anything. So it has to be above that 110 for call options for you to make any money. And a huge percentage of options expire worthless. And so it's probably just biting off more than you can chew, especially in sort of a beginner investor mindset.
So what happens if you buy it at 110 and it goes down? Do you essentially lose that $110?
So you buy an option on the stock. So let's say the option to buy it at 110, that option costs you $5 or something. And so if it doesn't hit 110, if it's below it, that $5 that you paid to purchase the option is worthless.
So you're not actually paying $110.
Right, you're just buying the option to buy it in the future.
Got it. And how do you go about buying that? Like when you're at a brokerage site and you want to buy, sell, or buy, or whatever, to go buy shares, is there another place to buy options?
Yeah, exactly.
Okay, got it.
Yeah, but it's pretty complicated and there's all sorts of strategies, so I'd say that it's probably not worth it to learn at this point.
And then what about, so you have to own stock in a company in order to buy options?
So technically you don't. You can actually buy the option to purchase a stock at the price, but you don't actually need to own the stock. But then on the put side, it's a very good idea to actually hold the stock, because it's pretty dangerous. If it's called selling puts naked, like it's called selling naked puts. It basically means you don't own the shares, and it's not a good idea. So I would recommend not doing that.
Sounds like something my bubby would say. Naked puts. All right. What is your opinion on ETFs versus growth stock mutual funds? And what are those?
Great question. So, mentioned it real briefly earlier, but a mutual fund is a collection of stocks. You could think of it similar to an index fund, but a mutual fund usually is overseen by a team of people who is scouring the globe for the best investment opportunities. And so it's actually a collection of stocks hand chosen by people, versus an index fund is very passive. So it's just the computer saying, okay, the market cap is this. It's automatically now a percentage of the index fund. So it's very much active versus passive. And ETFs are actually an interesting vehicle that sort of happened after mutual funds. And there's actively managed ETFs and there's passive ETFs. So it's pretty much just a vehicle in which there's collection of stocks. So an ETF stands for exchange traded funds. And it's what happens with the mutual fund is you can't trade it during the day, because what happens is the managers, they are trading their shares, and then at the end of the trading day, they say, here's the value of your shares in this mutual fund. But exchange traded fund, you can trade those ETFs real easily. And so it's essentially more liquidity, meaning you can trade in and out of it more.
And what's your opinion on those two? Do you have a preference?
So the big thing is fees. If all things equal, you want to pay fewer dollars in fees, and ETFs typically have lower fees. And I think a great index is just the S&P 500 ETF, and you could just trade that really easily. So the other thing that kind of is going off of that, if you pay a little bit more in fees for a mutual fund, but that return is much better over time, it probably makes sense. And so, like a famous personal finance guy, Dave Ramsey, he will say that he only buys growth stock mutual funds because you have a good amount of diversification and a little bit of growth. So I think that's definitely a viable strategy, and it really depends on the return that you can get from that growth stock mutual fund. So I mean, it's not really one or the other is better. It really depends on the returns that you're going to get and then the fees.
How do you know the returns you'll get?
You have no idea, but you can look at the track record of, say, this fund manager has been running this mutual fund for 20 years and he's outperformed the stock market by 3%. So, okay, I'm only paying 1% in fees. Maybe it makes sense to just go with that growth stock mutual fund. So it's a good idea to kind of look at the track record. That's a good idea in terms of, okay, is there going to be some alpha, meaning better returns than the market? But I would say that, I mean, it's just hard to tell, so definitely look into the fee structure, but that's a great way to do it. Just look at the track record and see if one is actually better than the market.
I have one last question. If you had the option to, because ultimately 50 years from now, you want to be financially secure and have had this much money build up over time, all that growth. If you knew in 50 years, you had the option to in 50 years be given that much money or go through the process of investing.
Oh, that's a super good question.
To get that amount of money.
Definitely the process.
Okay.
I mean, actually, let me think about that a little bit, because I think, like, personally for me, I really enjoy the process of it. But if there was something else that I really enjoyed, like I really just wanted to build this other business and I could focus all my attention on it rather than spending hours pouring through financial statements and stuff, it might make sense to go and, you know, found that other business or something. So it really depends on what somebody's natural curiosity and passion is. But I mean, if you just get the results, you won't have built the necessary skills. Like, basically, your results will be on a different level than your actual skills. And so I think that really, even if you got that money your skills wouldn't be caught up, and so you might even lose that money because you don't know how to actually handle it. You haven't gone through all of the, trauma of losing money in the stock market and just learning about the process. And so I think it's pretty dangerous because you see that all the time. NFL players, celebrities, they have all this money, but their skills in terms of managing that money haven't caught up because it happens so quickly. So I think there's definitely something to be said for the process of it and it just happening over time. And it's a very sort of certain process. Like if it's not really chance. I mean, a lot of people view investing as gambling, and if you just look over long periods of time, like over 20-year periods, like pretty much 100% of them, the stock market has been positive. And so it just provides a lot of long-term wealth building, and it's really just a great asset class if people want to build long-term wealth.
Cool.
Yeah, well, thanks so much for watching, guys. Hope you got something out of it. And if you have a question or something else that you want us to address, leave it in the comments and we'll try to get back to you. But once again, from me and my lovely fiance, thanks so much for watching.
Thank you.